Imagine it is the morning of March 17th, 2013. You're a 44-year-old accountant living in Nicosia, Cyprus. You woke up early, as you always do. You made your coffee. You sat at the small kitchen table by the window where the morning light comes in sideways and turns the tiles gold. Your daughter's university fees are due next month, 1,400 euros. Your savings account holds 82,000 euros. Money you spent 15 years building, euro by euro, through careful work and careful living. You have a small apartment that is almost paid off, a car that runs well, a job you have held for 11 years. You have plans for the summer. You have plans, period. This is not a rich man's life, but it is a solid one. It is exactly the kind of life that is supposed to be safe. You open your banking app, and the numbers are wrong. Not wrong like a glitch, not wrong like a display error you have seen before and know how to dismiss. Wrong in a way that makes the coffee go cold in your hand. Wrong in a way that your body understands before your mind catches up. Because overnight, while you slept, while your government met behind closed doors in Brussels with European finance ministers and International Monetary Fund officials, a decision was made. A decision that would permanently erase a portion of everything you had saved. Not stolen by a criminal, not lost in a bad investment you chose to make. Taken, legally, quietly, by the very institutions that were supposed to protect it. If you have ever wondered why banks can close overnight without warning, why governments can freeze your money without asking your permission, and what actually happens to ordinary people in the first 72 hours after a bank collapse, stay with me. What you are about to hear is not a theory, it is a pattern. It has happened before, across multiple countries, multiple centuries, and multiple economic systems that were all, at the time, considered stable. And it always ends the same way for the people who never saw it coming. If you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Because what happened in Cyprus in 2013 was not a freak event. It was not a once-in-a-generation accident limited to a small island economy in the eastern Mediterranean. It was a textbook example of something that has played out again and again throughout modern economic history. In wealthy countries and poor ones, in democracies and authoritarian states, in times of war and times of peace. And the first 72 hours, those specific critical hours, are the hours that determine everything. Who loses everything? Who loses nothing? And why the difference between those two groups almost never comes down to luck. This video is about those hours, what really happens inside them, what the historical record shows about how they unfold, who they destroy, and what the rare people who came through these events intact had in common that the people who were devastated did not. Before we go further, there is something important to understand about what a bank actually is. Because most people carry a fundamental misunderstanding with them their entire lives, and that misunderstanding is precisely what makes the first 72 hours after a collapse so completely devastating. A bank is not a vault. That is the mental image most people carry. A giant safe somewhere underground, cold and steel-lined and full, holding all the money that everyone has ever deposited. That image is wrong. A bank is far closer to a dam. It holds back a large reservoir made of deposits from thousands or millions of people, and it releases small, carefully controlled flows in the form of loans, mortgages, and investment returns back into the economy. The dam works perfectly, efficiently, invisibly, as long as everyone upstream keeps sending water and no one downstream panics and demands everything back at once. The moment that changes, the moment enough people lose confidence and rush to the dam simultaneously, the structure cannot hold, not because the dam was poorly designed, not because it was run by criminals, but because it was never designed to release everything at once. No dam is, no bank is. This mechanism is called a bank run, a sudden, simultaneous rush of depositors all trying to withdraw their money at the same moment. And it is the engine at the heart of almost every major banking collapse in the last 150 years. The bank does not have your money sitting there waiting for you. It has lent most of it out, in mortgages to families, in loans to businesses, in purchases of government bonds. When you ask for your money back at the same moment as thousands or hundreds of thousands of other people, there is simply not enough physical cash on hand to satisfy everyone. The bank falls, not because it was dishonest, but because the promise it made to everyone, your money is here, available whenever you need it, was always structurally a promise it could not keep if everyone called it in at once. What makes the first 72 hours so critical is this. That is the window in which the dam either holds or breaks permanently. That is the window in which governments either act decisively or hesitate fatally. And that is the window in which ordinary people, people with no insider knowledge, no political connections, no financial complexity in their lives at all, either take protective action or lose the ability to act at all. After 72 hours, in almost every historical case, the rules have changed. The accounts are frozen. The capital controls, meaning government-imposed limits on how much money you can withdraw or transfer, are in place. The exits have closed, and the decisions that could have been made before that window shut can no longer be made at all. Think of it this way. Collapse is not a fire. A fire announces itself with smoke and heat and alarm. Collapse is a river changing course. For months or years, it carves new channels underground, invisibly, silently, while the surface looks completely normal. And then one morning the ground simply gives way, and everyone standing on it falls together. Now here is where history gets uncomfortable. Because this is not a rare event confined to unstable economies or irresponsible governments. It is a recurring feature of modern financial systems across every era and every continent. And the case studies are not abstract. They are full of real people, real savings accounts, real lives that changed permanently in windows of hours and days. Let us go to Argentina, not March 2013, December 2001. A country of 36 million people had been living through 3 years of brutal recession. The government of Fernando de la Rua had borrowed heavily in US dollars throughout the 1990s to maintain an exchange rate that kept the peso artificially equal to the dollar. 1 peso, $1, a policy called convertibility. The problem was that Argentina's economy was not performing like a dollar economy. Productivity was lower, exports were more expensive, unemployment had climbed past 20%, and the banks, which had been lending enthusiastically during the boom years of the 1990s, were sitting on mountains of loans that were rapidly going bad. On December 1st, 2001, the government announced something called the corralito. That word means little fence in Spanish. And that is exactly what it was. A fence placed around your own money. Overnight, withdrawals were capped at 250 pesos, $250 at the official rate, per week. For a middle-class family, for a small business owner who needed to pay a supplier, for a pensioner who lived on monthly savings withdrawals, that limit was not a temporary inconvenience. It was a wall that had appeared overnight between them and everything they had built. Within 72 hours of the corralito announcement, Argentina had changed permanently in ways it would take a decade to fully measure. Street protests erupted across Buenos Aires and every major city. The government fell, not once, but 5 times in 11 days. 5 different presidents rotating through the Casa Rosada in a political collapse that mirrored the financial one. The peso was eventually depegged from the dollar in January 2002 and immediately lost roughly 70% of its value. Anyone whose savings were denominated in pesos watched the real value, meaning the actual purchasing power, what their money could actually buy, collapse by that same proportion. Anyone who had deposited US dollars in an Argentine bank found those dollars forcibly converted to pesos under a policy the government called pacification. Someone who had deposited 100,000 US dollars received an account balance of 140,000 pesos. When the peso subsequently fell to nearly 4 pesos per dollar on the open market, the real value of that deposit had been cut by roughly 2/3, not gradually, in weeks. The middle class bore the weight almost entirely. University professors, engineers, pharmacists, people who had worked hard and saved consistently, people who found themselves financially destroyed by decisions made by people that they had never voted for, in rooms they had never entered, in languages they had never been consulted in. But here is the detail that most people miss when they hear about Argentina. The first 72 hours were not when the collapse happened. The collapse had been building for at least 3 years before December 2001. The cracks were visible to anyone looking closely enough. The International Monetary Fund had been negotiating with Argentina all through that year. Bond markets had already priced in significant default risk. The structural rot was in the beams, not on the surface. The first 72 hours were simply the moment when the reality that had been hidden from public view suddenly became visible to everyone simultaneously. And by the time it was visible, the window to act had already closed. If you had been an ordinary Argentine saver in November 2001, not a banker, not an economist, just a person with a savings account, what specific signal would have told you that December was coming? What would you have looked for? And more importantly, what would have stopped you from acting even if you had seen it? Drop your answer in the comments, seriously. Because what I am about to show you next is the part of this story that most people never hear. And it changes everything about how you understand the way banking crises operate. The second case study takes us to Lebanon, specifically October 2019. After the devastating civil war that ended in 1990, Lebanon rebuilt its financial system around one central promise: stability. The Lebanese pound would be pegged firmly to the US dollar at a rate of 1,507 pounds per dollar, a rate that had held since 1997. Lebanese banks would offer high interest rates on deposits to attract capital from the enormous diaspora. The central bank would pay Lebanese commercial banks even higher returns to keep deposits flowing. What this created was a structure several economists compared to a Ponzi scheme, where new money coming in was used to pay the obligations on old money rather than generating real economic returns. The system worked as long as confidence held and dollars kept flowing in. The moment either of those conditions changed, the entire structure was mathematically unsustainable. The confidence broke in the autumn of 2019. Wildfires exposed the government's inability to provide services. Protests erupted over a small tax on WhatsApp calls. That small thing became a symbol of everything that was broken. Banks began imposing informal capital controls before any formal announcement. ATMs in Beirut ran dry. By 2022, the currency collapsed beyond 100,000 per dollar. A nurse who had worked in Ivory Coast for 20 years found her lifetime savings worth a fraction of what she had deposited. The total losses to Lebanese depositors have been estimated at over $70 billion. Most people believe bank failures are rare anomalies. If you are still here, you are not most people. Hit subscribe. Because the next section is about who actually gets destroyed and who walks away untouched. The United States, Tune 8. The specific story of Washington Mutual is the one that most directly mirrors what ordinary depositors experience in the first 72 hours of a bank collapse. WAMU was the sixth largest bank in the United States, with $307 billion in assets. In the 10 days following the collapse of Lehman Brothers on September 15, 2008, depositors withdrew approximately $16 billion from WAMU. That number is not a rounding error. It is a number that made the bank's position impossible. On the night of September 25, 2008, federal regulators from the Office of Thrift Supervision seized Washington Mutual. The FDIC, the Federal Deposit Insurance Corporation, the government agency that guarantees deposits up to a set limit, arranged an emergency sale of WAMU's assets to J.P. Morgan Chase in a transaction completed in hours. By the time most WAMU customers woke up the next morning, their bank no longer existed. The branches opened under a new name. Insured depositors, those with less than the federal guarantee limit in their accounts, did not lose a dollar. But shareholders, bondholders, and those with assets above the guarantee limit faced very different outcomes. What WAMU demonstrates is the speed. The digital age has fundamentally changed the timeline of bank collapse. In the 19th century, a bank run required people to physically travel to a building, stand in line and wait for a teller. That physical constraint put a natural speed limit on panic. Thousands of people moving through physical space takes time. In the 21st century, a bank run happens in an app. Silicon Valley Bank in March 2023 experienced what analysts estimated was $42 billion in withdrawal requests in a single day, largely driven by messages spreading through venture capital group chats and social media at the speed of text messages. The bank went from open to seized by regulators in roughly 48 hours. The first 72 hours have been compressed even further in the digital era. The window is narrowing. And here's the detail that almost no one outside of financial history circles knows about the broader 2008 crisis. Internal Federal Reserve documents show that in the weeks following the Lehman collapse, the entire American financial system came within hours of total systemic seizure. Not a recession. Not a crisis that could be managed with conventional tools. A complete freeze. A situation where no major bank could transact with any other, because no institution trusted any other institution's balance sheet. Ben Bernanke told a congressional panel in 2010 that of the 13 most important financial institutions in the United States, 12 were at risk of failure within a 2-week window in the autumn of 2008. 12 of 13. That number has never fully entered popular consciousness, but it describes with precision what a true systemic banking crisis looks like from the inside. At this point, the pattern becomes impossible to ignore. 3 countries, 3 different eras, 3 completely different political and economic systems. Argentina in 2001, a developing economy that had borrowed in foreign currency. Lebanon in 2019, a post-conflict state that had built its financial system on structural promises it could not keep. The United States in 2008, the largest economy, with the deepest financial markets and the most elaborate regulatory system in history. And in all 3 cases, the same mechanism operated. Confidence evaporated faster than institutions could respond. The first 72 hours determined the shape of everything that followed. And the people who were destroyed were overwhelmingly people who had followed the rules, trusted the institutions, and saved in ways they were told were safe. The same mechanism, different countries, different decades, different languages, same result. Now let us look directly at the human cost. Because the historical record is very specific about who bears the weight of banking collapses, and the pattern is consistent enough to constitute a structural feature. The people who get hurt the most are not the very wealthy. And they are not, in most cases, the very poor, who often have minimal bank exposure. The people who get hurt the most are the ones in the middle, the careful savers, the people who did exactly what they were told to do. Work hard, accumulate savings, keep them in a regulated, insured institution because that is the responsible thing. Those people are the most exposed. In Cyprus, in 2013, the eventual bailout terms imposed a levy, a forced percentage taken directly from deposits. a 47.5%. On deposits above 100,000 euros at Bank of Cyprus, someone with 180,000 euros in savings lost 38,000 euros overnight. Not in a speculative investment, not in a startup that failed, in a regulated bank account in a European Union member state, in a country that used the euro, backed by European institutions that were supposed to prevent this. Small business owners who kept their working capital in Cypriot bank accounts found themselves unable to meet payroll, not because their businesses had failed, because their government had made a decision in Brussels at 2 a.m. In Weimar Germany in 1923, the hyperinflation destroyed the savings of the German middle class as a consequence of a system pushed beyond its limits. A family that had saved diligently for 20 years to buy a house found that by the autumn of 1923, their entire savings account would not purchase a single loaf of bread. Teachers, civil servants, small factory owners, the backbone of German middle-class life, were effectively wiped out in months. The political consequences of that destruction produced resentment and desperation in an entire generation, and echoed through the following 2 decades of history. In Zimbabwe between 2007 and 2009, inflation reached figures so extreme that the government eventually issued a $100 trillion bill, a denomination that could not purchase a bus ticket. People who held Zimbabwean dollar savings watched them become worthless in real time. Those who had access to foreign currency, or who held assets in land or livestock or goods, survived. Those who held savings in the formal banking system lost everything. The contrast is stark and consistent. In Cyprus, those who had diversified banking relationships across multiple European jurisdictions were shielded from the full levy. In Argentina, those who held dollar cash outside the banking system, or who had property owned outright, retained real-world resources when the financial system froze. In Lebanon, those whose assets were denominated in foreign currencies, held physically or in foreign accounts, maintained purchasing power while others watched wealth dissolve. The pattern does not require a conspiracy to explain. It simply reflects the structural reality that concentrated exposure to a single system creates vulnerability. The question is not whether this pattern will repeat. History has already answered that. Banking crises have occurred in virtually every decade of the past 2 centuries. The only question is whether you will see the structural conditions developing before they become the first 72 hours. If this helps you, subscribe. What the historical record shows consistently when you study the people who stayed standing is not that the survivors were richer or more sophisticated. What it shows is that they had made structural decisions, long before any crisis arrived, that distributed their exposure across multiple systems. This is not a prescriptive list of financial recommendations. This is a description of patterns that appear repeatedly across the historical record. The first pattern is diversification across institutions and jurisdictions, not because these individuals predicted a collapse, but because they had a structural habit of not concentrating all financial resources in a single institution or a single country's regulatory framework. Some depositors had accounts split between jurisdictions. The levy fell only on Cypriot deposits. Those with cross-border banking relationships were partially or fully spared. This is not an exotic strategy. It is a structural habit of distributing exposure, the same logic that applies to not keeping all of one's physical possessions in a single location. The second pattern is a different relationship to assets that exist outside the banking system entirely, across Argentina, Lebanon, Weimar Germany, and Zimbabwe. The historical record consistently shows that individuals who held a portion of their wealth in forms that the banking system could not freeze survived. Property owned outright, or durable goods with real-world value, or foreign currency held physically, gave access to resources when banking systems became inaccessible. This is not a recommendation to distrust all institutions. It is a description of what the historical record repeatedly shows about structural resilience. The third pattern is speed of awareness and response. In almost every banking crisis studied in detail, there was a window, sometimes measured in hours, in which information about the deteriorating situation was spreading unevenly. People connected to professionals began adjusting their positions before the general public. In Cyprus, capital outflows in the weeks preceding the bailout were later estimated in the billions. In Argentina, funds were moved for months before December 2001. This is not illegal behavior. It is the straightforward reality that in complex systems under stress, information travels unevenly, and speed is a variable. The fourth pattern is the discipline to avoid panic-driven decision-making at the peak of uncertainty. This sounds paradoxical, but is crucial. Individuals who made large, rapid, irreversible financial decisions at the exact moment of maximum uncertainty frequently locked in losses that others limited. In 2008, individuals who sold equity holdings at the market trough permanently absorbed losses that those who held or selectively added to positions did not. The historical record does not reward paralysis, but it shows that decisions made at the height of fear produce worse outcomes than decisions made within structure. Now we return to Nicosia. To the accountant at the kitchen table in the early morning light of March 17th, 2013, with the cold coffee and the phone. His story did not end in March 2013. Cyprus's banking system after the catastrophe was restructured. Capital controls were gradually loosened and fully lifted. The Cypriot economy contracted sharply. Unemployment rose significantly and real hardship spread. But the country did not collapse into extended chaos. The floor held eventually. The families who absorbed the initial blow without making catastrophic secondary decisions, without panic selling homes, found a floor. The ones who were most permanently harmed were not always those who lost the most in the initial levy. They were those who made irreversible decisions in fear. The window that defines everything is not only the window in which external events unfold. It is the window in which your own decisions are made. This window operates under the most intense psychological pressure you will likely ever face regarding money. The lesson of every crisis is specific. Systems, which appear stable, can become unstable faster than individuals can respond if those individuals have placed all resources inside a single system. The first 72 hours after a bank collapse change lives permanently, not because of those specific hours, but because of every decision never made. The accountant in Nicosia eventually paid his daughter's university fees. It took longer than planned. It required renegotiation and sacrifice and adjustments. His solid life was disrupted, bent out of shape, and slowly rebuilt into something different. He was not destroyed, but he was changed permanently. Hours that, in the years before them, were already being determined by forces he had never been shown how to see. This is historical analysis. It is not financial advice. The situations described, Cyprus, Argentina, Lebanon, the US, Germany, Zimbabwe, were each complex and multifaceted. The patterns identified here are for educational purposes only. Every individual financial situation is unique. Please consult a qualified financial professional. This video is not for everyone. Most people will hear it, nod, and go back to assuming it is someone else's problem in some other country. But if one person in your life is carrying savings they have never questioned, in institutions they have never examined, they need to hear this. Not because it will save the world, because it might save their world. Share this video with them, subscribe for more, and I will see you in the next one. The window is narrowing. History has already answered the question. The shape of everything that follows is determined in those first 72 hours.